Apple has been on an incredible run. This company's gone up something like 35% in the past month. It's caught a lot of attention. The valuation has expanded for it. And now we have different people, chart masters, technical analysts going on to CNBC and telling us that we need to, quote, sell it all. Not just trim, not just lighten up on our holding. It is time to exit entirely out of Apple. That is what this chart master is saying. And now I want to respond to him because this video on CNBC got a lot of attention. It has nearly 40,000 views on YouTube. A lot of people are interested in it. And I thought that I would give my feedback, my thoughts on his thought process here, him saying to sell out of Apple as a long-term Apple shareholder. So in this video, I'm going to go ahead and listen to what he has to say. It's of interest to me because I own a lot of Apple. In my dividend portfolio, this is one that I don't really show too often on this channel, but this is a dividend growth portfolio. Apple's my very top holding with $58,700 in value. A lot of that is from gains, $23,000, and most of those gains have happened precisely by ignoring people that tell me to sell Apple. By ignoring them, I've had much better gains than had I given heed to all of their warnings. We also have Apple in the Story Fund. This is the portfolio that I routinely track on this account. I have Apple as an individual holding, $5,000 worth. I'm in the green by $2,000. So I've made even more gains on this company in this portfolio. And then I even own a little bit more of it by virtue of owning Berkshire Hathaway. They have 40% of their public portfolio in Apple. So I am overexposed to Apple. I have this company everywhere, and I'm completely fine with that because I love owning this company. Now, when I get different headlines like this of people saying, sell everything, it's attention grabbing, and it's something that I want to listen to. So this is the actual clip from CNBC. It's only a couple minutes long, but I want to go ahead and just walk through this with you. This is the guy, I don't know his name, but he's on CNBC, and he was just introduced and explaining why now's time to not just trim, but to sell everything.
This call went out today, and it had exclamations in the headline, and that really caught my eye. So walk us through.
Well, hold on. Yes, but no exclamation points. I hold back on those, but certainly emphatic. To write "sell it all" is certainly definitive, right, and emphatic. And here's the thing. We know, before we look at the charts, we know that what makes a market is just exactly what you see in Apple. It's the largest stock out there. It's 7.3% of the S&P, and it's covered by some 40, 50 analysts. In fact, there are people whose 12-month price targets are as high as 220 and as low as 140 from top 10, top 5 brokerage firms. And there is the rub. How can one man or woman or one analyst think it's worth 220 and one think it's worth 140? With the same access, the same information, the same spreadsheets and Q's and K's. And
I kind of agree with that predicament here that he brings up. People can have access to the exact same information and they conclude entirely different results from it. Some are right, some are wrong. Overall, the market, I think, has some efficiency to it. So I do agree with the thesis to some extent. But if you're on the right side of it, if you have a better estimate of what a company is worth or whether it's worth holding long-term, it's going to beat the market, I think there is room for outperformance on a systematic basis. But he gets to the point further here, so let's go ahead and keep listening.
Then here's a technician. I'm sure the technicians that want to ride the momentum, my thinking is, this technician, that it's just too steep, uncorrected, almost unnatural. Let's look at some angles.
He says it's too steep, uncorrected, and unnatural. And I want to bring up the chart here to illustrate this because I think what he says, we'll bring up Apple stock here on the price chart. What he says, I think, is it's accurate. We look at this chart here and look at the trend upwards over the past like 35 days. It's up 34% with very little volatility. There's some days where it's gone down a little bit, 3%, but very little volatility. So that is a true point. He brings up that it's too steep, unnatural. There's little down days on it. But what about when it fell? And when it fell 23%? It's basically the same thing, just in reverse. This is how some stocks seem to trade. I'm no technical chart analyst. That's not even what I go into at all. But this doesn't look entirely out there. It seems like something normal in my experience. So I don't see anything crazy about that chart. It looks like the company went on a good run. It has momentum at play. But let's see what he says.
So the first chart is a comparative chart, and it's just Apple versus the QQQ. It's peers, if you will. And it's a one-year comparative chart, and we know the spread is what it is. The numbers are Apple's up 16, 70%, the Q's down 10. If we take this back a bit further, take a look at a 5-year chart. We have the same spread, meaning Apple outperforming the QQQ, of which is, of course, a big part. So there is some autocorrelation. But Apple's up 340%, Q's are up 130. Or the 10-year.
Okay. A couple immediate feedback on this. Short term, Apple's outperforming the QQQ year to date. Who cares? I can't draw any conclusions about this short term, right? Just going back 1 year, companies can do anything. When he talks about Apple outperforming the QQQ over this longer timeline here, 342% to 132%, this makes sense to me. Apple is twice as good of a company, qualitatively, quantitatively, looking at the metrics, looking at the brand value, looking at the franchise value, looking at the diversified income, looking at the return on capital employed, the free cash flow growth. Everything about it is much better than the average company, which makes sense of why it would have much better returns than the average company. So it makes sense to me that Apple has outperformed to a huge extent. It is a much better company than the average company. Let's continue on with this.
But Apple's up 340%, Q's are up 130. Or the 10-year final comparative chart, we know that, again, Apple has more than doubled the other large 100 stocks in the NASDAQ 100 represented by the QQQ. So
now he zooms out again another 10 years, and it's basically the same thing here. I think he's painting the picture that Apple has had dramatic outperformance, which is correct, but in my opinion, it's well deserved. The fundamental performance is twice as good as the average company. Apple's grown their free cash flow. They have higher returns on capital employed. They have higher margins. They have a better balance sheet. They have better brand value. So it makes sense to me that their price has followed their fundamental performance. But let's go ahead and see the ultimate point he's trying to make here.
But the here and now is what sort of gives me pause. Let's look at two charts. What we know from the absolute low of June 16th, Apple's up 35%. And the angle of the line is becoming increasingly unnatural. No givebacks, not even a down 2-day sequence. And so not only do we have that sort of unnatural line.
He repeatedly refers to the line as unnatural, this line right here going upwards, which it is. It's just straight up, right? There's not 2 days of a red day in Apple for the past month and a half. I think there's a couple factors at play there. One of them is if you're a big bear on Apple and you don't want to own the stock, you've already sold out of the company at this point, and Apple or Berkshire has bought your shares. Apple does share buybacks to an extent that no other company can match. They buy back billions worth of shares every single month. So if there's any sellers out there, Apple's the buyer. They're just going to be buying back the shares. And that puts a lot of upward pressure on the stock. So this may seem unnatural, but part of it, at least some of it, is a consequence of their massive cash flows they shovel back into buybacks. I would assume during this time period, I don't know this for sure, but my assumption is Apple's done a ton of buybacks.
We're up against a downtrend line, which is annotated quite clearly there on the screen. It also is otherwise known as a megaphone. Forget about what that kind of talk is. It's a move to a difficult level. And if you pull this back and we do one more chart, it's just putting this in context of going back to a pre-pandemic wipeout. And so, again, there'll be people who say, no, you stick with momentum, you ride it until it starts to show you reasons not to. My thinking is that to some extent, this is almost the face of fear. People are hiding or wanting to be in this particular stock, maybe at the exclusion of all others. For instance, of the stocks in the QQQ, there were only 10 up today. But Apple leading the way yet again. Just a little too popular, a little too happy, a little too good.
That's his basic argument. Going back on this, he shows this chart here, which has these two lines. One of them, the top one is a line of resistance and a downward slope there. And he's basically saying, look, Apple has had this pattern now, twice of meeting this line of resistance, and it just met the third time. So now it should start trending back downwards, back down to this bottom sloping one. So it should go down somewhere like right here, right? That would be the charting. Now, he might be correct. That's the thing. This is a whole different art, a different way of investing, and some people are successful doing this. In my opinion, though, it's really difficult because you look at this, and if Apple does just, there's some chart masters, some people like him, they'll say, no, you follow momentum. Apple has strong momentum, and you don't sell it when it has strong momentum. Remember, people want to buy a stock going up more than they want to buy one going down. So momentum sometimes compounds. When a stock goes up, that's not exactly the best time to sell it because a lot of times it going up causes more people to want to buy it. They FOMO in, it goes up more and more and more. So you might exit out way too early. So there's disagreements with this, but overall, I think it's very difficult. A couple of things I want to mention on Apple. If you look at trading it, you have to play the game like this chart master is doing. And I think that that's difficult to do. When you're looking at the charts here, you're trying to time the upwards and downwards, you're drawing lines on it. You might get lucky, you might be able to do that. But unless you have a very refined process, you know what you're doing to a huge extent, I think that's very difficult to do. What I look at Apple is I have a very simple thought process here. I will hold this company as long as I think the valuation's reasonable and I think it will outperform the S&P 500 over the next 5 years. Right now, I think that's the case. It trades at a elevated price to earnings ratio. A lot of people mention that, but the company continues to grow. They continue to grow their free cash flow on a per share basis. Last year, their free cash flow per share went up 33%, much faster than the average company in the S&P 500, much faster than even high quality companies. The free cash flow per share is growing rapidly for Apple. Meanwhile, I think their business is getting stronger qualitatively. Brand value is increasing. Their product portfolio is diversifying. They're getting into more categories outside of just devices like media, entertainment. They can always support their stock price with rapid share buybacks. So we have the shares outstanding going downwards all the time. The returns on capital employed for Apple since 2005 have always been above 20%, which the average of the S&P 500 is 16%. So they're effectively reinvesting cash back into their business. They're paying a growing dividend. They have minor amounts of cash and debt, and we can look at some other things qualitatively going on. Here's another thing. A lot of people ask me, Joseph, why do you stay invested in Apple when the company's top line revenue growth is slowing down? It's going from being like 15% and 16% down to 4 or 5% top line revenue growth. And my answer to that is you don't pay dividends with revenue. You don't do share buybacks with revenue. Not all revenue is the same. And what really matters is how much of that money you're able to keep after you earn it. And what Apple's doing is even though their top line revenue is slowing down a little bit, they're earning more meaningful revenue with higher margins. Part of this is illustrated in the amount of subscriptions this company sells. This is a graph of, it's Morgan Stanley, and they did analysis on what their thoughts are. This is research they did on Apple. So this isn't the official numbers, but this is based off Morgan Stanley research on an estimation of how many total subscriptions Apple has sold. And look at this chart. In 2016, it was 150 million. In December of 2017, they surpassed Netflix, surpassed Disney, surpassed basically every other company in the world. That was back in 2017. Now, their latest estimate is at 860 million subscriptions, paid subscriptions. The change in subscribers year over year is a consistent 30 to 40 plus million per quarter. Per quarter, they're adding 40 million subscribers on different services. This is Apple Care. This is Apple Music. This is iCloud. This is Apple TV Plus. On and on and on. Apple Fitness, so on and so forth. Their news, all those different things. Right now, Apple has 860 million subscribers to their various subscriptions. They are a massive subscription business, not just a device business. And I think by the end of 2025, this will at least be a billion subscriptions sold. So overall, my point here is not that this guy is wrong. He is a technical analyst. He's a chart master. And this is what he does. He looks at the short term. He looks at human behavior and how these things trade. A lot of it is influenced by these support resistant lines, and he could be correct. Maybe he is correct. I still think if he's correct, I'm not wrong. We're just playing two different games. His is very short term based on trading patterns and human behavior. Mine is long term based on fundamental developments of the company and its intrinsic value. We're playing two very different games. And when I look at these type of charts showing Apple gaining 40 million subscriptions per quarter, when I look at the fundamentals of Apple, the brand value of the company, the growing revenue, the growing free cash flow per share, the massive growing dividends, the EPS, the share buybacks, the consistent returns on capital employed, about doubling the market average. It's difficult for me to want to sell this company, especially at a 27 PE ratio. It's just not pricey enough for me to want to sell it. So that's just my thoughts on this whole sell all your Apple from CNBC. You can look at that stuff and it's interesting, but you have to decide what type of investor you are. Are you trading based off of short-term technicals, support lines, and resistance lines, or are you trading based on the fundamentals of the company and the developments you see happening over the next 5 years? I am firmly in the latter camp. So that's my thoughts overall. I hope you enjoyed this little update on Apple. As of now, I am not selling all of my shares.